Welcome everybody to today's webinar on implementing the CUSMA. We're going to give it a couple of minutes and watch those participant numbers come up. And I'm going to go on mute for about a minute and then we'll get ready to start. Well, thank you everybody for joining us this morning again on the tail end of a pandemic and on the on-ramp to a brand new trading world between Canada and its two most important trading partners, the USA and Mexico. Over the past 3 years, we've been engaged in negotiations, discussions, refinements, fights, interpretations, and everything in between on what the new relationship between the three countries will be over the next couple of decades, we think. A lot of angst at the beginning of those discussions and certainly some fights in the middle, but best friends and trading partners are there for reasons, mostly here because of geography, but also shared values and principles. We negotiated a new agreement, and that agreement is called NAFTA 2.0 by all normal people. And then there's a good subsection of people who are in the business like us, who call it USMCA. And seeing that we're Canadians and the Canadian government has put its own brand on it, the Canada-US-Mexico agreement is CUSMA, and what we're here to discuss this morning. Before I introduce our esteemed panel, I want to remind everybody that this is being recorded and will be made available later. Today, we're joined by two very formidable forces in the trade spaces. I've had the pleasure of working with both in all different corners of the new agreement and the relationship that led to it. Our partners at KPMG brought us together today, and Joy Nott, who is a partner on trade and customs. She's a partner with KPMG in Canada's indirect tax practice with a focus on trade and customs. She brings 30 years plus experience to the practice with deep expertise in imports and exports, international trade and trade compliance. Joy's bio is this long, but I'll say that I met her in another life when she was the president of the Canadian Association of Importers and Exporters, when we did a lot of the same work on the Trans-Pacific Partnership. Yeah. And in doing the biggest trade deal in the world to that point in time, a lot of it came down to the analysis and the application. And we sought Joy's counsel many times, and it's a deep pleasure that she's here for us with this today. Our other panelist is our dear friend Karin Muller. Karin is the Director of Customs Compliance and Trade Governance for Magna. She brings 40 years of customs and trade experience in various senior consulting, operation, and management roles. Karin's bio is as extensive as Joy's, but I'll add with a lot of pride that she is the chair of the APMA International Trade Committee. We joke, but it's true. I work for Karin on trade issues. And we spend a lot of time in the public space trying to negotiate the agreement publicly, but we go to Karin and her APMA CUSMA working group to get practical application on how this actually works on the ground, which is why we're here today. July 1st is an entry into force date. There's a lot of debate whether that means enforcement, and there's a lot of data that needs to be collected, analyzed, and properly presented. There's questions of certification, there's questions of timing, there's questions of content, and you all ask me the types of questions that I go to Joy and Karin for answers. And so today, Joy and Karin are going to bring us to where we need to be for next week's entry into force. And without any further ado, I'd like to pass this on to Joy.
Thank you so much, Flavio, and thank you to everyone for tuning in today. What we're going to do today is we're going to go over a roadmap sort of what companies should have been doing up to now to sort of prepare for this. And don't feel bad if you haven't completed all the steps. You're in good company. As Flavio alluded to, it's been an interesting journey in this negotiation. We're going to cover the rules of origin for automotive parts and very quickly for the OEMs. We're going to talk about the certification, the documentation, and then finally we're going to wrap it up with a poll and some Q&A. So to get started, Flavio already alluded to the fact that this particular agreement, unlike NAFTA, has a different name in all three countries. USMCA, CUSMA, I've heard it pronounced the two different ways, and then TMEC for Mexico. Karin is probably one of the leaders in trying to get a uniform way amongst the three countries of referring to this agreement. So if you look, the letters U, C, and T are highlighted at the beginning of each one of those, and Karin and I support her on this, we're trying to get a new acronym floating across the three countries where the single agreement with three different names is referred to in one way, UCT. So, but no matter, as it says at the bottom, no matter which of the three names you call it, or four names if you want to include UCT, what's important to understand is that on July 1st, midnight on June 30th, the old NAFTA agreement as a piece of law ceases to exist. USMCA, CUSMA, TMEC, whatever you want to call it, is not an enhancement of NAFTA. It's not a change to that piece of legislation. It supersedes it. So
Joy, can
yeah.
you hear me?
Yes.
A panelist or somebody just came on and said that they lost sound. They lost audio. Al, are you there? Okay, keep going.
Okay. Oops. So no matter what, sorry, the new legislation is actually superseding the old NAFTA. So that means a bunch of different things. If you think NAFTA is literally coming to an end, so documentation, contracts, anything else where the reference to NAFTA exists, you really have to think about it, because then now that's referencing a piece of law that as of July 1st will not exist anymore. So it needs to be updated to existing law. So I won't belabor that point, but I just wanted to make sure that everybody was clear on the fact that this is not an enhancement to NAFTA, it's a brand new piece of legislation. Now, moving along to hopefully, you know, what you've been thinking about for the past, well, throughout the entire negotiations and how these negotiations were going to impact your company. Starting at the beginning of this road here in the first yellow dot, I'm not going to walk through these in great detail, but you know, obviously you should have been thinking about your systems and how you had previously for the past 24 plus years had NAFTA, various things connected into your system, whether that be rules of origin, anything that you were using systems for, that those systems were going to need to be migrated away from NAFTA onto this new agreement. Hopefully you were also taking a look as the various drafts and stuff came out to do an impact analysis to understand for your company what these new rules and what this change was actually going to mean for your company. Moving on to the third dot, then you know, sending instructions out to your supply chain to get your solicitation documents and the information from your supply chain in on how their products now qualify or don't qualify for the new rules, so that you can take that in and actually start to have a really good understanding of what potential changes you might need to make on your supply chain so that your end product qualifies. Obviously, moving to the fourth dot, taking a look at that documentation, updating things, moving away from NAFTA and moving into the UCT world, moving to the fourth dot, qualifying your finished product, whatever that may be, under the new rules. And as I said earlier, if it doesn't qualify, doing some sort of impact analysis to try and figure out what needs to change to make it qualify. And then finally, the turquoise dot, July 1st, which we're about a week away from. It goes into effect, and NAFTA will not be declared anymore on July 1st. So NAFTA certificates of origin, anything that says NAFTA, that's not going to be acceptable anymore. As I just said, it's a new piece of legislation. So July 1st will come. Your customs brokers will start making different kinds of declarations for you on the assumption that you're able to give them the documentations. And then post July 1st, just like NAFTA, it's an evergreen process where suppliers will be updating information. And I suspect that for the next little while, as everybody gets used to this new agreement, the amount of changes that will come in from your suppliers to you, advising you that they've either changed sources of supply, they're either going to be able to now certify something qualifies for CUSMA or withdraw a previous certification. There's going to be, I think, a lot of churn in the marketplace for the next little while. So that's kind of the roadmap of moving from NAFTA, moving away from NAFTA into the UCT. If you're not completely finished this road of transition, you know, and I'll defer to Karin as well for her comments on this, but it's my experience that you're in good company. For a lot of companies, watching the negotiation process and not really knowing where the shoe was going to drop, you may not be completely down this road. Wherever you are on this road, you know, if you're not finished, you're in good company. So there's no need to panic. And Karin, I don't know if you wanted to say anything there relative to sort of moving from one to the other.
No, I think, you know, you've touched on all of the points. You know, it's literally unprecedented to learn and comply with such a complex and new set of rules in origin in less than 30 months or in 30 days, let alone during a pandemic. It's just, there's a lot of challenges. The good news is, though, that we're all in the same boat. So as a supplier, we are facing the same issues that our customers are facing. I do want to say, though, that if anybody does know anybody who's working in the trade compliance field, you know, they're working hard to understand the rules, and even if they're in your company, and they really want to try and make sure that the customers get their qualification documents by July 1st. But that's not necessarily going to happen because it goes down the chain. So in order for me to qualify for, you know, for a good or on a good that I send to a customer, I need to go down to my suppliers and get the solicitation documents and the certification documents. And when people are just starting to come back to work now, it's definitely making it a lot more difficult. So while our customers are definitely pushing for their documents so that they can do the work, they also recognize the reality. So the only thing I can suggest there is that, you know, if you do have a customer who is emailing you 40 times a day, then I would suggest reach out to them and just talk to them and let them know what some of the challenges you are having in making sure that they get the correct documentation.
Yeah, I would concur with that.
Yeah.
Now I will turn it over to you, Karin, to sort of walk us through this table of some of the major elements that changed.
Yeah, so this is your high-level overview of the UCT. As everyone is aware, this is a trilateral agreement between Canada, Mexico, and the US. However, there's a very detailed definition if you're interested in that in the agreement. We didn't put it here. Suffice it to say that, you know, in Canada, it's provinces and territories. In Mexico, it's the states and Mexico City. And of course, in the US, it's the 50 states, including District of Columbia, Puerto Rico, and the foreign trade zones. They also talk in this particular section, they talk about the land and the sky and the sea. So again, if you want more details on that definition, it is available in the agreement. The challenging part of all of this agreement is the entry into force date, which, you know, despite a lot of lobbying efforts from industry, July 1st, 2020 became the entry into force date. And as I had alluded to earlier, the uniform regulations only came out on June 3rd, so it gives us all less than 30 days to try and figure out what we're doing and getting the supporting documents from our suppliers so we can respond to our customer requests. But this also becomes a solicitation nightmare because the auto industry is very used to the calendar year, January 1, December to 31st. Now, all of a sudden, we have to take into account mid-year. So you have some customers and some suppliers who are certifying from July 1st to December 31st, and then they'll start again in January, and then they need to do it again for when year 2 starts, July 1st, 2021. We at Magna, to alleviate some of the administrative burden, we decided to go for the 365 days. So we're asking our suppliers to certify from July 1st, 2020 to June 30th, 2021, because we feel that we will have all of the data that we need to respond to our customer requests in the event that they're going to break it down into 6-month periods. Again, that is a business decision that you will have to take a look at. So for example, you know, you might have cost increases that take place in January 1, that might impact your regional value content when you're doing the calculations. So you might feel that the 6-month period is better for your particular company. Again, you have to take a look at that. We also have product specific rules. So, you know, it's really important to note that the calculation methodology, the formula, a lot of the things that were in the NAFTA are the same under UCT. What has changed is the introduction of new terminology, the introduction of automotive product specific rules, and the transition period for regional value content, where it changes every year until we come to the final RVC in the 4th year. So if you keep that in the back of your mind, it may not sound or it may not be as overwhelming, because if you have calculated and qualified under the old agreement, you'll be able to do the same thing here. So what we have is 2 product specific rules of origin is how I have broken it down. We have the standard product specific rules of origin, which is very similar to the NAFTA. It's based on the tariff classification of the finished good to be exported. Those can also be found in Chapter 4, similar to where you could find them under the NAFTA. Then we have the automotive product specific rules of origin, and it's also based on the tariff classification number. So you can define the automotive product specific rules of origin as any good that is classified between headings 8701 through 8708, and any good in the standard product-specific rules of origin that has a footnote referencing the automotive product-specific rules of origin. And that's all I'm going to really get into from a technical aspect. Hopefully what you're going to be able to take away from this 1 hour session is that you know, you will need, I think, further training in the technical aspects of the rules of origin. And then if you do have a customs department and they come to you and say, we need training, please listen to them, because there are key differences in how you calculate the regional value content. The automotive product specific rules of origin also introduced 4 terms. Well, yeah, 4 terms. One is core, principal, complementary, and other. So what I suggest in this.
Karin, you muted yourself.
Yeah, you muted yourself, Karin.
Sorry, I did. That was by accident. So what I would suggest to make this a little bit easier for you is that you identify your priority parts right now that cross the border. Identify what the tariff classification number of those parts are, and if it was eligible under the NAFTA, and what the rule of origin it was under NAFTA. And then go to the UCT rules of origin and do that comparison. The majority of companies have less than 15 tariff classification numbers. So, you know, again, if you break it down like that, then it won't appear as overwhelming. The automotive, well, I'll talk about steel and aluminum in a minute. So then from a parts perspective, the eligibility determination is no different than the NAFTA. It qualifies either using tariff shift or regional value content. Again, it's going to depend on what the percentage is based on the table it falls under, core, principal, or complementary, or you can use tariff shift and regional value content. So again, that is going to depend on the tariff classification and what the rule of origin says, but it's no different than the NAFTA. So the big difference though is for vehicles, because in order for a vehicle to qualify, they have to meet 4 requirements. And if any one of those requirements are not met, then they cannot qualify the vehicle as UCT originating. And you can see here that, you know, for RVC, eventually at the end of their transition period, they have to meet 75%. They also have to meet 75% on a core part, which Joy will go through a little bit later. They have to meet 70% steel and aluminum and 40% labor value content at the end of the transition period. And again, as I said, Joy will be touching on those in detail a little bit later. Also, the de minimis has increased. It's finally on par with the other free trade agreements that we have. It's been increased from 7 to 10%. And then the documents. So under the NAFTA, we had our infamous certificate of origin. But the great thing about that document is that everybody knew what they were filling. Everybody was filling out the same document. So USTR and Global Affairs and Mexico, in their wisdom, they thought that they would be helping industry if they removed a legislated document requirement, which I guess, you know, in most cases it would be okay, but for our sector, it is, it's turned into administrative nightmare. I'm sure a lot of you, if you're already in the solicitation process, you are receiving different templates from your suppliers, you're receiving different templates from your customers. And so now everybody is sort of pushing back and arguing back and forth whether or not a certain data field is required. We tried to come up with a standard document, and we were only partially successful. But, you know, I think what's going to happen in this is a living agreement that we are kind of living through over the course of the next 12 to 18 months. And I think as everyone starts to feel more comfortable with it and starts to understand what the rules are, you're going to see a lot of processes and documentation change until it finally settles down into something that we can all work with and that hopefully will be consistent across the board. And then finally, the thing that I will touch on, while it really doesn't impact the CUSMA, Canada, it does impact imports into the US, and that's the merchandise processing fee. So the merchandise processing fee is a customs user fee that is applied and is based on the value to a maximum and minimum on entries or imports into the US. If a good is eligible for UCT, then you don't have to pay that merchandise processing fee and it's exempt. However, let's say a customer or you do not have a supplier certification on hand at the time of the import into the US, you are required to pay the duty. You have a year in which to claim back that duty, but you cannot get a refund of the merchandise processing fee or customs user fee when you claim back the duty. And this was a mistake. It was an oversight on USTR's part, although they made the same mistake under NAFTA and it took them 4 years to correct it. So I'm not sure how this oversight happened, but it did. So again, industry went crazy because this has the potential to add a lot of cost to imports into the US for importers and our customers. So we have been assured that this rule will change and that MPF will be refundable. And even though there's no 100% guarantee, most likely it will be retroactive. There is precedence for that. So I have no reason to believe that it will not be retroactive. And one of the precedents is even the NAFTA. So once they got their ducks in order, people were able to go back 4 years and claim the merchandise processing fee that they paid. So those are, in a nutshell, those are the treaty highlights. I think I covered most of what I wanted to cover. So Joy, I'll turn it back over to you.
Thanks, Karin. So, you know, what Karin just went through was basically UCT in what, under 10 minutes. So it's kind of like drinking from a fire hose. We recognize that. So as Karin said, what we're going to do is we're going to slow down a little bit now, and we're going to take a look at some of the things that she actually mentioned. So these are the rules of origin for the OEMs. So Karin already covered this, but if you look at this diagram shows, starting on the left-hand side, that in the end state, after the 4-year transition, as things, you know, the percentages for regional value content change over the 4 years. In its end state, finished vehicles will need a 75% regional value content versus NAFTA, which was 62.5. Now I'm talking passenger vehicles and light trucks here, just to be clear. And as Karin said, there's 3 main components there. There's the labor value content, there's the specific rule of origin for automotive parts, there's the RVC that's in the bubble, and then there's the steel and aluminum requirement. Now that labor value content breaks down. It's $16 an hour US, and it breaks down into 3 main chunks. 25% is supposed to be high wage material and manufacturing expenditures, 10% technology, and 5% assembly. Now, 40% for passenger vehicles, 45% for light trucks in its end state. So for the automotive industry, and Karin, I'm going to, sort of flip back to you here in a second to say, these are the OEM rules. This is the rules for the cars, not the parts. However, I'm sure you can appreciate that steel and aluminum needing to be 70% originating, the parts are what's made of the steel and aluminum. So it's going to flip back to parts manufacturers, although these rules do not apply to the parts manufacturers, they apply to the car. So there's that proverbial Venn diagram. And Karin, I'll flip back to you for some commentary on, for example, I'll just say the steel and aluminum at 70% originating, and what does that mean for a parts manufacturer who now is going to have a customer that needs to meet this rule? What's the expectation? And you're on mute, by the way. And what's the expectation from a parts manufacturer from your perspective?
Yeah, thanks, Joy. So one of the things that I think maybe before I answer that, I'd like to take a second to talk about the alternative staging regime. So the requirements for a lot of the OEMs are tough, and they need time in order to get to the max of the retirements or the requirements. So there is what is called an alternative staging regime that allows vehicle producers to apply for an extension beyond the 4-year transition. And they can apply for this extension for regional value content, labor value content, steel and aluminum, so my understanding is that the majority of the OEs are applying for this. It's not available for our sector, like for the service providers or the parts manufacturers, but they have to go through a very lengthy application process. Like, they want to know what you had for breakfast 4 years ago. It's insane. Once they are approved, then they can take a longer time to get to the end state. What that means for us as a parts provider is that, or a parts manufacturer, is that really nothing. If they are approved under the alternative staging regime and they need anything from us, then they will reach out and say, look, you said that this particular stamping, which is a core part, is not eligible. We have been approved under this ASR, which is the alternative staging regime, to take on a lower RVC for a particular period of time. Can you please recalculate your RVC to see if it's eligible under the lower rate, which I believe is like a 62.5 or a 60%. I can't remember what it is off the top of my head. So that's the only time where we would come into the picture, is if the, if the OE asks us to recalculate. From the steel and aluminum, and again, the steel and aluminum and the labor value content, as Joy alluded to, is an OE requirement. It is not a supplier requirement. But our OEs may need help to meet their requirements. And if they do, then they will come to us and they will ask us to provide them with an LVC, labor value content statement, certifying that maybe the part that we made for them, and it should be a key component, is built in a facility that pays a minimum $16 US an hour. In Canada, that's $20.88. And in Mexico, it's $294.22 Mexico pesos, I should say. So it does vary between countries. That's the reason why they would come to us to ask for an LVC, but they shouldn't be asking for LVC on every part, which is what some of the customers are doing. And again, I guess you have to figure out what your relationship is you know, with the customer as to how you are going to respond to those requests. But I just wanted to let you know why they are coming to you, asking you for it. It shouldn't be on every single part. They need to do their work first. Once they've done their calculation and they know it's a key component, then they should be asking you for that information. And the same thing for the steel and aluminum. They're not asking for you know, you to provide the value of the steel and aluminum content in your part unless it's a key component. If you are getting that request for every single part that you are providing, then I would suggest that you have a discussion with them, because if they're doing that, then they're in deeper trouble than we thought. Also on the steel, oh, there was another point I was going to make on the steel and aluminum. I can't remember the point. If I think about it, then I will.
Sure we'll be talking about steel and aluminum again before this webinar ends. So
Yeah.
I'm just conscious of time, and just the takeaway, I guess, from everything that Karin and I have said is that these are the automotive, the vehicle rules. So as parts manufacturers, you don't have to meet these rules, but then it'll become a contractual negotiation with your customers on helping them to reach these rules. So these are not your rules, but this kind of stuff could show up in contract negotiations. And I guess that's the main takeaway from this particular one. Now, getting into the actual rules for, again, this is vehicles. Again, conscious of time, I'm going to go through this table quickly. Karin, feel free to jump in at any point. But as we've already said, you know, NAFTA had 62.5% regional value content. After everything is said and done, and I'll put aside the alternative staging for a moment, because as it stands right now, at the end of the 4 years, it'll be 75% RVC. The tracing list under NAFTA had certain parts. The RVC in table A2 for core parts still exists, but what I wanted to draw the attention, what's important on this slide, I think from my perspective, is the fact that the steel, 70% steel and 70% aluminum from North America. Under NAFTA, there was no such requirement. We just talked about that. But the labor value content, under NAFTA, there was no such requirement. We talked about that. So that's new. But then what's at the bottom here, under NAFTA, they used to have a tracing list. And in the tracing list, if a particular part was being traced, it had to qualify. If it wasn't a traced part, it was deemed to originate. That logic now has gone away, and now it's everything has to qualify, has per the rule of origin, so there's no deemed originating anymore. And that's an important distinction. So for a lot of parts manufacturers that KPMG has been working with, for a lot of them, this particular rule here at the bottom, this particular provision at the bottom, actually had significant impact for them, because suddenly with the tracing list going away and the fact that if particular components were not traced, it didn't need to qualify, all of a sudden that has sort of blossomed as an issue. So Karin, I don't know if there's anything that you want to add to that. I mean, it would all depend.
Just a quick comment on the roll up. I think what's really important for the audience to know is that with the roll-up methodology, now that trace value has been taken away, 100% of that value is now considered to be originating. So once you have met the rule of origin, it doesn't matter how many other pieces of non-originating material you have in your finished part. The customer can take 100% of the value and use that originating value as part of their calculation. Unlike trace, where they could only take certain pieces, now they can take 100%. And I think that is probably the key takeaway.
Thank you. So now moving on to the parts rules of origin. Karin talked earlier about the fact that there's new terminology in this particular agreement. So you've got core parts, which are found in table A, principal parts, tables B and D, and then complementary parts, tables C and D. Now on this particular page, we're talking about passenger vehicles, light trucks, and heavy duty trucks. So that this page is a little bit more comprehensive than the previous slide. So, you know, going across the top bullet point across all three, you can see that you need to understand what kind of parts your particular parts are falling into, core parts, principal, or complementary, because as you look across the top bullet point across all three columns, you'll see that there's different regional value content thresholds that need to be met by the time the agreement has fully matured. In the second bullet point in all three, you'll see the actual sort of staging, the various percentages as the years tick by. And then finally, in the fourth bullet point, you'll see, sorry, in the third bullet point, you'll see examples of what is actually considered to be core parts, principal parts, or complementary parts. So just as an example, core parts, the drive axles, bodies for motor vehicles, looking at principal parts, examples, ball bearings, brake systems, and then complementary parts, it's everything from audio equipment to catalytic converters. So whereas before there was never this distinction between these three buckets of what kind of parts are we talking about? Parts used to be parts. Now parts divide up into these three important categories. So Karin, I don't know if there's anything additional that you want to add here.
Yeah, so this is extremely high level, and you know, just based on the audience, we didn't want to get into a lot of technical discussion on this, but we do plan on facilitating, or APMA does plan on facilitating a more in-depth technical training on this. But I think the takeaway on this particular issue is that once you know which table your good is on, then you have your regional value content, and then you can continue to calculate your RVC just like you did under the NAFTA. And I know I make that simple, and it does sound a little bit simple, but that's the key. Another key point is that tariff shift still applies. So if your finished good that you sell to your customer is can qualify using a tariff shift, then you don't need to go to these tables. You only need to go to these tables if the rule of origin is telling you that you need a regional value content. So that's
Okay.
yeah.
So again, I won't spend a lot of time on this other than the fact that the point that Karin made earlier with the fact that this agreement is not starting on a January 1st start date, which is traditional, has been traditional, at least in Canada, for its free trade agreements. This one is starting on July 1st. So the staging categories become ticked down now on July 1st every year, as opposed to January 1st. Again, just conscious of time, Karin, is there anything that you want to add to this particular slide? Okay. So as Karin talked about earlier, there is no format, and I wholeheartedly agree with her, unless you actually work in the trenches every day. Saying something like, oh, well, we will remove the bureaucracy of having a specific form that needs to be completed. That sounds great, I guess, to bureaucrats. For when you actually try and operationalize that and put it into and try and execute it through complex supply chains and through small and large companies, what it does is it took away the standardization of passing information from one party to the next. As Karin said, there has been attempts by various people, and KPMG has an example of a certificate. You know, if you want one, feel free to email me after this and I'll send you an actual certificate that looks like this, because we're having people ask us. In theory, you can give the information and you can receive the information as to whether or not the goods that are being bought and sold from each other on any kind of documentation. So it could appear in the center of an invoice, in the body of an invoice. It could appear, you know, on POs. It could appear as a separate piece of paper, but it doesn't look like the example here on the screen. The important thing to take away is that there are 9 specific areas that no matter how the document, no matter what it looks like, if it's going to be in the body of an invoice, if that's what makes sense for your company in order to be able to push out information to your supply chain, to your customers, however you do it, it needs to contain these particular 9 data elements. And I guess the most common question that I'm asked here, that I'm asked normally when I start to talk about the actual paperwork is, and I repeat it over and over again, and I try everything that I can to get the word out there. But the most common question I get asked is, well, on July 1st, if my rule of origin did not change from NAFTA to UCT, on July 1st, can't I just continue to use my NAFTA certificate? And Karen's smiling. And the answer to that is no. And it's no across all 3 countries, because I also have had people say to me, well, I know the Americans are saying they won't accept it, but what about Canada and Mexico? It's no across all 3 countries. And why is it no across all 3 countries? Think back to where we started this webinar, where we talked about the fact that on June 30th at midnight, NAFTA dies. And a new law, which we've nicknamed UCT, is coming into place. So if you have certifications and you have attestations and you've got official documentation that says NAFTA at the top and it's signed at the bottom, what do you think happens on July 1st? That piece of law is gone. So no, it's not acceptable to use NAFTA certificates. I will, I'll sort of flow right into the US administration enforcement here. What is generally being accepted is that you can do something unlike NAFTA. There's 3 parties that can certify. The exporter, the producer, and now the importer for the first time can actually sign a statement that the goods qualify. Under NAFTA, the importer couldn't sign, but now they can. So if you have all that underlying data from your supply chain, and if either your rule of origin has not changed, or even if it has changed, but you have the underlying information that's required to figure out that it qualifies under the new rule, as an importer, you can self-certify. But if you're going to self-certify, you need to be held to the same standards, and you would have to have the same audit trail and the same data elements and the same backup documents to prove, just like the exporter used to under NAFTA. So be careful in that. Because I've had some people say to me, well, I'll just take my NAFTA certificate and I'm just going to flip it, and I will say that, oh, now I have a CUSMA, a UCT certificate, and I'll sign it as the importer, and this NAFTA certificate will be my backup. If the rules of origin have not changed at all for your product, that's an okay strategy. But be aware that if the rules have changed, without something in writing from your supplier who's got the costed bill of materials and can actually, look to make sure, because they know their manufacturing process, I would really hesitate on self-certifying, because, as I said earlier, you have to have the same audit trail as anybody else. But now moving into US administration and enforcement overall. So 3 things. Karin already touched upon the fact about the merchandise processing fee will not be permitted to be refunded on if you don't have your certificate on hand July 1st, you'll have to pay the merchandise processing fee going into the United States. As it currently stands, if you later get the certificate, the merchandise processing fee is not currently going to be refundable. To be determined at some date in the future as to whether or not and when that gets fixed. I've already talked about the second point about the 9 data elements. And finally, probably the most important thing on this particular slide is that the United States has come out, US CBP has come out, and they've had a number of different public webinars and phone calls with stakeholders to say that they understand that, to the points that Karin made earlier, the short timeline that companies had in order to comply with the new rules, they have stated that they are going to take maximum flexibility for the first 6 months. That doesn't mean it's a free-for-all. That doesn't mean that they won't audit or they won't, issue penalties. If you are flagrantly, offside and it's just really obvious, and you're not taking the proper precautions and whatnot to show reasonable care and all due diligence to the fact that there is a new law, I'll just put a warning out there to say maximum flexibility does not mean that they're not going to enforce whatsoever. It just means that they recognize the fact that there are challenges and that they are willing to work with industry to help educate and to help and to give people a little bit of time to get the data and whatnot that they need. Now, Canada and Mexico have not formally come out in the same way that US CBP has come out to say that they're going to implement this policy of maximum flexibility. Canada has not said something similar. What I will say is that in the current environment, meaning we're about to enter into a new free trade agreement with our largest trading partner in the midst of a pandemic, the Canadian government overall has when it comes to all things compliance during the pandemic, just like the US, it doesn't mean that they're going to turn a blind eye to something that is obviously non-compliant, or if anyone is intentionally trying to, skirt the law or otherwise, not take the proper due diligence to respect the fact that there are laws in place. The Canadian government has sort of said, look, we understand companies are already going through enough with the pandemic, and now our new free trade agreement with our largest trading partner. The government is not going to try and make it difficult on companies, such as sparking audits just because they feel like it. But that doesn't mean that they won't apply the rules or enforcement if they see something flagrantly wrong. Now in Mexico, there's a different kind of, I spoke to my counterpart in Mexico for his thoughts on enforcement and where the Mexican government plans on going with this. And he has said they have not talked about flexibility, and they have not even talked about, in the same way that Canada's general stance has been from the whole of government of Canada, saying, they're willing to work with companies because of the pandemic. Mexico has not taken those kinds of stances. And in fact, informally and somewhat semi-formally, the Mexican government has reminded companies and people in Mexico that if they falsify UCT documents, that there are penalties right up to and including jail time. So don't really know what's going to happen when day one happens with the Mexican authorities and their enforcement. Karin, I don't know if you're hearing anything different than what KPMG has heard in Mexico.
Not Mexico, but I think we're getting close to, we're 10 minutes to the hour. I do want to caution you that Canada will not come out with a flexible approach. They feel that they have published enough information where we should be able to be compliant. Whether or not we agree or disagree with that, it is important to take into account when you do your own risk analysis on how you're going to approach the agreement. Okay.
So now we want to hear from you. So as Karin alluded to earlier, KPMG and APMA have been talking about potentially putting together some training at different levels: executive training, 101 type training for beginners who are not familiar with the old NAFTA. So they sort of need to go back to the beginning on rules of origin and how to calculate a regional value content. And then of course another course for people who do have experience with NAFTA, and what they're really looking to understand is the new UCT rules. So that right now there's a poll that's up. There are 6 questions. We require that you answer all 6 questions, even if it's to say that the particular question is not of interest of you or just doesn't apply to you. Please respond to all 6 questions and then click submit, simply because APMA really relies upon this kind of information to help you, its members, in order to give you the experience and the value for membership that you need. So we're going to wait a couple of seconds here, and the poll, please click all 6 questions, and then in order to be able to hit submit. And then I guess while people are doing this, Flavio, what we can do is roll right over into the Q&A section. I don't know if there's any questions that have come in, but I'll sort of defer to you, Flavio.
Thank you, Joanne. And there's a bunch of questions, and I'm looking at time. We probably have time for 2 or 3 of them, so I'll waste very little time in getting to one that we've been asked many times here about the new labor value content provision. So 40%, if you make a vehicle in a facility that pays less than $16 an hour, you need to source 40% of that content from suppliers that pay $16 an hour. Question is, does labor value content include the cost of benefits, retirement savings, etc.? Is there a formula to determine this rate? Either one of you.
So I'll take that one on because I've been living and breathing this for the last couple of weeks. So there is not a formula for parts manufacturers because it's not our requirement. There is a very complex formula for the OEs. So I definitely feel for them in trying to get to where they need to go. The LVC has a number of exclusions, and the cost of benefits, retirement savings are not included. So there is a definition of what can be included in LVC in both the US CBP interim instructions on USMCA. And then Canada also has a definition around it in the Canadian Uniform Regulations that they completed for June 3rd. Like LVC, I could go on for 20 minutes on LVC. If you want to send a separate email to either Joy or APMA, we can get back to you with a more detailed response. But yeah, I hope that answers.
Let me just, and I know that you and I have had this conversation probably daily for about 8 months now. For the OEs, does the $16 an hour cover the wage only or the wage plus benefits?
You're muted.
You're muted.
It covers the wage only. You cannot include benefits. You cannot include benefits. You cannot include any type of profit sharing. You cannot include overtime, and you cannot include shift premium. And you do have to include your temporary workers. So that means that you will have to go to your agency that you use, your temp agency, and you will have to get that data so that you can include it in your calculation.
And all of that language is in the CVP guidelines published on June the 16th and in the Canadian guidelines published on June the 3rd. And if anybody needs it and they can't find it, send us an email and we'll share it for you.
Great.
Maybe time for one or two more quick questions. And one that had come in early is, can I self-certify if I do not get a certification from a supplier?
So I'll take that one, and then Karin, feel free to add. So as I explained earlier, if you've got all the data and you feel that you could, if audited and asked to justify your signature on a self-certification, that you've got, if there's an RVC to the rule, that you've got all the costing sheets and everything else that you need to be able to prove how you got to the RVC, and or you know all of the components and tariff classifications that are on the bill of material if it's a tariff shift, if you feel that you can meet those thresholds and standards, then fine, sign it. But for most companies, their suppliers would not normally share that confidential information such as costing and whatnot with them. So be very careful if you're going to self-certify. You need to be able to understand whether or not your original rule changed or not. And if it did, you know, I can't give advice just to the universe, but if it was me, I don't think I would self-certify if my rule of origin between NAFTA and UCT changed and I had nothing else other than a NAFTA cert from my supplier. I don't personally think I would take that risk. Karin?
Yeah, I agree with that, Joy. Importer certification is a big risk, and I do know that the customers are a little bit concerned about that, as we would be. You know, you need to have your audit trail to support your qualification, and if you don't have that, or if you can't get it, then you could be in trouble down the road.
Yeah, because the penalties would apply to you, and penalties are one thing, but then if you're audited and any of the three governments tell you that your certificate is now invalid, you need to now take that and trickle it down through your customer chain to say, sorry, that certificate that I gave you months ago or years ago has now been declared invalid, which then starts a whole chain of events for them, which I'm sure you don't want to put your clients through that. So self-certifying as an importer, if your rules haven't changed, okay. If your rules have changed, wow, be careful.
Well, on that note, Joy and Karin, we're out of time except for me to thank you, to thank KPMG, to thank you, Joy, to thank you, Karin, and to thank Magna for their leadership, and everybody who's a patron of our webinar series. We're always available to you. Appreciate the questions, your participation, and you're constantly coming to us to help you in your business. I wish you all the best. And thank you very much. And just thank you also for providing data in that poll. Enjoy the rest of your week. And we're here, all of us are here for you as we go through this new agreement. Thank you.
Thank you.
Thanks, everyone.
Thank you.